Let's get over to David Kudla right now. We've been telling you that he's coming on with us, and now he's finally here. So we're happy, as always, to talk to David. He has as I was saying earlier, a big following in terms of the listeners just write into us whenever you come on, David. So we're always grateful to get your insight. Mainstay Capital Management out in Michigan there, $3.5 billion of assets under management. The question I've been asking for weeks, and I haven't gotten a sufficient answer to, is what's going on with rates? Why are we at 124 on the 10-year? Why is the real yield negative 1%? What does it mean to you?
It doesn't mean the same thing to me. Good morning, Matt, and I hope the listeners are writing in good things about me.
Yeah, of course.
But it doesn't mean the same thing to me that it means to some people. I think that there's still people that are looking for signals from the bond market, like the old days. And when I say the old days, I mean before there was so much manipulation of rates by the Federal Reserve, and we could count on the bond market to send us signals about the economy and to send us signals and normal reaction functions that could help us in our investments and where we should be going in the markets. But especially in the past 15 months, but even before that, I think it says more about the amount of liquidity, the amount of asset purchases by not just by our Fed, but by the ECB and other central banks. They're just pushing yields down, and it has just distorted the picture so much. If you think about back in the 1980s when we were at 5.5% inflation, where were bond yields then compared to today? We're sitting here at 1.27. 127 basis points on a 10-year, 192 on a 30-year, with inflation last read we had at 5.4%. So it's not about a reaction to the economy, a reaction to inflation. It's about the Fed. We are just awash with liquidity. The asset purchases mostly by the Fed, bonds and MBSs mostly being purchased by the Fed, and just driving rates down.
Hey, David, the pandemic, unfortunately, is still with us. A lot of folks feel like we're on the other side of it, but there's still that Delta variant. How are you guys thinking about it from a stock selection perspective or a sector perspective as it relates to, hey, this thing might be with us maybe a little bit longer?
Well, it was an easy. I'll just say it was an easy trade last year, and I'm not saying that in hindsight. We went with the stay-at-home IT, e-commerce, those trades last year. And I think a lot of investors, a lot of professionals did very well in that environment. And a lot of investors and professionals are frustrated this year with this constant rotation back and forth between value and growth, whether it's month to month, week to week, or like this week, day to day, just the difference between Monday and Tuesday. And, one of the things that we're looking at that we think makes sense for investors in their portfolios for two reasons is there's this constant argument where the leadership will be between growth and value is to look at defensives, and defensives, we haven't had a 5% correction in the market, or I should say pullback since last October. We usually get or the average is at least 3 of those in a year, at least 10% correction in a year. And so there's concern about that. That's where defensive positioning in a portfolio can help. Also, so one area is healthcare to look at is a good one for that. And with these renewed concerns about COVID with the Delta variant, one area we like in particular is medical devices, medical technology and devices, because as we saw, and you've been reporting on the show, our 7-day average in cases in this country had gotten down at the end of June to about 11,000, and we've ramped back up to over 40,000 with the Delta variant.
I was wondering, because you're in Michigan near Detroit, right? Just north of Royal Oak there, and you have about $3.5 billion in assets under management, but your one of the top 100 independent financial advisors for years and years at Barron's. Forbes rates you one of the top 100 wealth advisors. You went to Stanford and did all of everything that the super smart Wall Street guys need to do, but you're not on Wall Street. What's business like there? Is it any different? Are your clients calling in from here, or do you have a local base?
So we really consider ourselves a national advisor. We have clients in 47 states and 12 other countries because of people, business is global these days. So we have investors that move around the country or from around the country and move around the world. Certainly we have a lot here in Michigan, a lot of clients that are in the auto industry. We do,
yep.
but certainly represent, clients
global
across
business.
the entire country.
Yep.
Yeah, and global business.
All right, David, thank you so much for joining us. We always appreciate getting your insight. We appreciate your time. David Kudla, founder, CEO, and chief investment strategist for Mainstay Capital.